Okay, good morning, everyone. Thanks for joining us here today. We're going to go ahead and get started, so if everybody can just take their seats, that'd be great. I want to try to keep things on time. So good morning. My name is Brett Eichenberger. I'm with Cohen & Co. I'm a partner and the market leader of our registered funds practice. Cohen & Co. is a independent registered public accounting firm. We're a big player in not only the ETF space, but the registered fund space as a whole. So as a firm, we're the fourth largest auditor of registered funds in the country, working with over 1,800 registered funds. That includes ETFs, mutual funds, closed-end funds, and interval funds. And then particularly on the ETF side, we're the second largest auditor of ETFs in the country. And in addition to that, we actually work with more investment advisors in the ETF space than any other firm. So really proud of where we're at in the ETF space. And I think our discussion is going to be really great today because we can mirror both the mutual fund side of things and the ETF side of things. So I've got a great group of panelists here. We got Josh Weinberg from the ICI, and I'll have everybody introduce themselves. We have Paul DeSalvo from JP Morgan, Mike Prendergast from Ultimus Fund Solutions, and we have Avi Nachmani from Independent Trustee, and also he does a lot of work on ETF research side. So Josh, if you want to go ahead and introduce yourself, and then we'll get things started as we go along the group.
There we go. Josh Weinberg, Associate General Counsel at the Investment Company Institute, and I focus my time on ETFs.
Paul DeSalvo, I lead ETF business development and solutions at JP Morgan Security Services. We support roughly $3 trillion in ETF assets currently.
Mike Prendergast, ETF product head at Ultimus Fund Solutions. We're a full-service administrator. We also offer statutory distribution. We also offer compliance services, CCO services. We sponsor 10 Series Trust, which provides a turnkey solution to our clients looking to enter into the registered product space.
Hi, good morning. My name is Avi. I've been very lucky to have observed the evolution of the mutual fund industry and the ETF industry. For many years, I founded a company called Strategic Insight. As it happened, it's 25 years since I did research. My first ETF major study was in 2000. So 25 years ago, the entire ETF industry was 50 billion or about at the time. So clearly I've been an observer of much of the evolution of the industry. About a year and a half ago, I decided I don't know enough about ETFs. So I worked with ETF Global and published 6 studies on ETF structure, evolution, cost, et cetera, et cetera. So I'm very, very happy to be today here.
Well, great. Well, we have a lot we want to talk about with respect to ETF share class. So we're going to start off with the background. Where are we at? Has an ETF share class been around for 20 plus years? So we'll talk a little bit about the background and where we're at today and kind of what managers are thinking about and where they've been. Then we're going to talk about some of the pros and cons with respect to the ETF share class. We'll talk about the capital markets, distribution. Got Avi here to speak really on some of the trustee oversight piece of this. And I know there were some updated applications that mentioned this. So there's a lot to discuss here, and we want to kind of delve into it, not just at a service level, but some of the operational issues that we think that need to be addressed in the marketplace. So Josh, if you want to kick us off on a little bit of the history and then how we're at where we at today with respect to exemptive relief.
Sure. So this all started around 2000 when Vanguard had a great idea to launch a fund that had an ETF as a share class. And so they went to the SEC and they got the necessary exemptive relief. And they also got a patent to protect the structure for a number of years. That initial relief applied only to their index-based products. Over time, they went to the SEC to try to expand that relief to their actively managed suite. But the SEC declined to issue that relief. As we know, in the year 2019, the SEC adopted Rule 6c11, which specifically excluded ETFs as a share class, citing policy considerations that would be best taken up under other means. And then in 2023, the patent expired and we saw a number of applications go in for the exemptive relief. Now, the applications went in under the prior administration and they piled up, and there was a significant period of waiting. And when the first comments came out from the SEC, they were extensive, they were exhaustive, they asked for an incredible amount of data and analysis, and seemed that they were designed to provide more education and more time for the staff to consider the policy issues that had been raised. Fast forward to the new administration, and you've got then acting chair Ueda making public statements about prioritizing this as one of the top things that he wanted to achieve in his time as acting chair at the SEC. And so now we've seen a couple of developments. Most recently, you've got the dimensional second amended application for ETF share class relief that is reflective of the sort of the current state of thinking following a number of discussions that the SEC staff has had with industry and others.
And just to, kind of give your 2 cents on it, when do you think we're going to see approval for this? Is this in the next couple of months? Or
Really trying to spice it up there.
I think given the fact that you've just seen the DFA second amended application go in last week, you just saw an amended SIBO application. I still think there's a little bit of time before this gets approved. So I'm not going to put a time frame on it, but it's still going to be some time. We're not talking about this month or next month.
Okay. Paul, I think what where we've been since 2021 in this space is asset management firms, traditional asset management firms will say, have thought about, do I launch an ETF product? Do I clone a product? Do I convert a product? Now we have another option. So can you walk through kind of from a product development standpoint, where should people be thinking about ETF share class in that discussion?
And quickly, let's just acknowledge that you blew through the guardrail on the first question with Josh. The one thing he said was, don't ask me about timelines. So without a doubt, exciting times. This concept is opening up a lot of oxygen to have conversations around ETFs across the board with existing and new emerging issuers. A common question I get in my seat is, my CEO or someone in management just flipped me an email. They saw this article. Like, where does this fit into the overarching approach? Like, how do I frame this going forward? Is this the silver bullet we've been waiting for? Like, just give me a logic or an approach to kind of organized thought process around this. And Brett kind of mentioned, it's my personal opinion. The other tools in the ETF toolbox are not going to disappear when we get an approval and we're ready for it or not. But just a quick way to think about it is everyone's used to launching a product from scratch, de novo. And that could be, if you want to use the vernacular, that could be a fully replicated product, a clone, or it could be a cousin that has enough differentiation with another piece of IP that doesn't create conflicts of interest. And then the last 3 or 4 years, obviously the prevalence of ETF conversions has increased as well. And what are you essentially doing there? You're harvesting existing assets. You're trying to leverage a performance track record that's already been built up. You have a stable management team. And that could be via a mutual fund conversion or utilizing a 351 conversion if it makes sense for your business. The ETF share class is just another tool in the toolbox. I don't think those other flavors are going to go away. Now, the proportion of your pulling on those levers might change as things mature over the coming years, but there's trade-offs, there's positives and negatives. Some of those you're significantly compromised if you have money in defined contribution plans. I think one of the big benefits of this mechanism as it develops is being able to leverage some of that money that's quote unquote trapped in those plans. But just kind of use that as a simple framework to think about and be able to answer the question of your internal constituents, like where does this fit in as the undercurrents continue to change? This is one thing that I think can have some stability over the coming years.
I think one of the things that we talk about too with their investment management firms is, can you talk a little bit about how this changes kind of their business? when you think about running a mutual fund, you have shareholders coming in and out of the fund at NAV. You have to keep a cash portion of the portfolio. You're generally trading the portfolio on your own. And this kind of turns that upside down a little bit when you think about the portfolio is as a whole. So you're not going to have, two portfolios within the share classes. Share classes have been around for a long time for a lot of different reasons, but it's still managing one portfolio. So can you talk about some of the things they need to think about from a portfolio management perspective? And Mike, if you want to take that one.
I mean, from an operational standpoint, the investment manager needs to sort of understand how do they incorporate the ETF ecosystem into their current portfolio management strategy. So it's really developing operational workflows to support the in-kind processing of trades, custom baskets, the ability, obviously, to you want to be in compliance with 6011 reporting requirements. So you have to be comfortable with providing full transparency of the portfolio holdings. Understand, obviously, what your custom basket procedures would be, and basically, working, expanding your trading relationships to actually include your lead market maker, because they're going to look for trade flow. So it's just understanding the operational components of that, making sure you have the procedures, understanding the ecosystem, and then determining how that is going to fit into how you currently manage your portfolio, because it's going to be different than what they currently know. And it's sort of walking them through that process and making tweaks to their existing sort of investment management strategy to how operationally do you connect into the ecosystem efficiently.
Do you think management firms will build out their own infrastructure? Do you think this is an opportunity for firms to, outsource that to a trading firm?
Yeah, I mean, it's one of those decision points as you go through the process, understanding what do they need to do? Do they have the capabilities to do so? Or do they want to actually push that out, use a sub-advisor for the time being to, potentially use that as a sort of a temporary situation?
I think one of the original things that I was noticing talking to mutual fund companies that haven't already touched the space is the realization all of the mechanics, the ecosystem requirements, the stakeholders of an ETF still apply in this construct, and you're going to have the same challenges to wrangle and get through, whether it be it's an outsourced solution, bringing someone in-house with expertise or otherwise.
Yeah, I think that's a good point. I mean, this is no different really than a conversion in a lot of ways. It could be a quasi conversion too when you think about it. You could see a scenario where you launch you collapse your other share classes. Maybe you keep a mutual fund share class, but you launch an ETF share class, and you could see yourself even potentially, depending on again your shareholder base, you could then convert that class, that existing class, into the ETF share class as well, and then essentially you just have an ETF at that point. Avi, I want to bring you into the conversation a little bit, just around when you think about kind of the oversight. Not all mutual funds really qualify from a portfolio construction standpoint to be an ETF from a liquid market standpoint. The market makers may look at some of the positions that you have in the portfolio and say, these are potentially product problematic. Obviously, mutual funds under the 40 Act rules can hold up to 15% of their assets in illiquid securities. That's something we don't see very often in the ETF space. Maybe talk a little bit about that.
First, I want to give a timeline, because at Strategic Insight, that's what I did. So my timeline is September 5th. The reason is that it's my son's birthday, but it's actually Freddie Mercury's birthday as well. So I think at the end of the summer, we're going to get. So anyway, that's my forecast. Can quote me. Yeah, I mean, we're going to see how that unfolds. One of the questions that I have is this just, just another tool, another extension, and we have seen the direction of travel for quite some time? Or is this, over the next few years, significantly changes the nature of, the investment management industry? Is this there's a mutual fund 1.0 and 2.0 and 4.0? Is this a 9.0 event? And my sense, it is a significant event in the overall perspective of the industry. There's a lot of work to do in terms of all the conflict and the setup. Obviously, we have heard some of that earlier today and going forward. But I think paying attention to this as if this is a significant transition point for the entire ecosystem that we have been part of. That's my view. The specific elements, to be hashed. But that's I'm not answering your question exactly, but I think that's where I am in terms of my thinking.
One thing to add there is that the way that the application is currently framed, it would require daily portfolio holdings disclosure. And so to the extent that you're an asset manager who has some secret sauce that they don't want to disclose, you're going to have some limitations in your ability to launch a share class ETF.
Josh, I know there was some in the beginning, and it's still an issue at and we'll talk about some of the board oversight piece of this, but there's this risk of class subsidization. And again, I mentioned earlier, share classes for mutual funds have been around for a long time, and you could argue that those same discussions are relevant here with share class subsidization. So just kind of give your thoughts, Josh, on how do you see that being overseen, some of the challenges or some of those questions that need to be answered?
Yeah, well, I mean, you'll have seen in the most recent iteration of the DFA application that it outlines a framework for the advisor to oversee and collect information about things that might contribute to the cross subsidization. And it requires the advisor to work with the board to set up a framework. It incorporates a number of the specific elements that were included in the first amended application, but it makes those optional, things that the advisor can consider, things that the advisor might want to take a look at. But the way that the application is structured right now, it puts it more consistent with the way that boards are overseeing conflicts amongst the share classes, taking into consideration the fact that there are some differences between a mutual fund share class and an ETF share class.
Yeah, I think the thing I spend a lot of time thinking about is generally ETFs have been unitary fee structures, meaning they just have a management fee. When you think about traditional mutual funds, yes, they can be unitary fee structures, but generally they're not. They have other expenses such as 12b1 fees, blue sky fees, other, kind of fees that are just associated with traditional mutual funds. So the operational thing I think you want to think about, and Mike, love to hear your opinion on this, but you think about, do you stay as a unitary fee structure or switch to a unitary fee structure, or do you just have the fund pay its own expenses and put an expense limitation agreement in place amongst each of the share classes so that you could still flow through 12b1 fees for the mutual fund share class?
Yeah, in a mutual fund is that it's a vehicle that has subsidizations all over it. The mutuality, the institutional shareholders subsidize the retail shareholder. The retail share, some retail shareholder. So the vehicle is there's a mutuality to it, and I think that would allow, as the conversation develops, I think there will be some acceptance of some of these friction points.
Yeah.
I mean, I think there's benefits to keeping the mutual fund expense structure with the ETF share class. We see now some new ETFs coming to market utilizing that structure. Because primarily, if you look at it, the unitary fee was put in place when we had passively managed or index-based ETFs, and people could just say, okay, back out the expense ratio, and they should be tracking the index. Not as big of a deal with the actively managed. You're posting what your expense ratios are. People are putting caps on those. So in theory, you're creating a unitary fee because you're going to cap your fees. And then there's some benefit as the fund grows that those expenses will start to come down. You also have some benefit there of if you're reimbursing the fund, you can actually you can collect that reimbursement back over a period of time. Whereas you go into a unitary fee structure, you're paying all the expenses. There is no opportunity to sort of go back and take back your, what you had contributed for. But if your ETF then is growing significantly, obviously the unitary fee is what it is. But so there's pros and cons about doing that. But I mean, operationally, it probably makes it's going to be easier to sort of keep that expense structure in the ETF share class. It's to sort of allow you to sort of maintain how you currently do expenses. And I don't think there's a huge detriment to the fund of potentially that ETF expense ratio going down over time.
Mhm.
I don't think it's going to be a huge driver of who's buying and selling your ETF.
One of the other things that has the market figured out yet? And I know, when you think about Vanguard, they have their own broker dealer. Just from a complexity standpoint, from your seat, Mike, as a service provider, with a traditional mutual fund, you have individual shareholders coming in and buying shares of the fund. Whereas in an ETF, obviously everybody knows that there's creation units that come through to transact with the fund. How do you see the plumbing being built? Things that the industry needs to think about from that perspective, from the capital markets piece down to the traditional, what I'd call traditional transfer agency piece.
Well, I think there's a lot of talk about this. On the transfer agent side, obviously the mutual fund TA piece is typically all together, and in some cases, many cases, you're going to have a different transfer agent for the ETF share class. So the opportunity within most of the filings, all the filings here, there's this option to do an exchange privilege from the mutual fund share class to the ETF share class. And how can that be automated? Because it's more, shareholder is interested in moving over, most likely through an intermediary account, and coordinating that transfer of those assets from the mutual fund to the ETF, and technically dealing with two different sort of settlement processes. Currently, the NSCC process that is supported exchanges through mutual funds doesn't have the functionality to support the ETFs at the current moment. So there is an industry working group trying to take that on, determining the guidelines of automating that process, but it most likely is not going to be ready when the ETF share class is actually given effectiveness.
Yeah.
So there's an interim spot where the industry is coming up with some guidelines to handle this in a quasi-manual fashion to affect that. So, I mean, I think, the industry will figure it out. We always do. We've been doing this for quite some time. And as new products come to market, we, band together and figure out a process that will support it. But there will be an interim period where we're going to support that, I say, in a semi-manual process, or at least come up with a process how that will affect, because you have an NSCC settlement of the ETF, but then you have the ETF shares will actually settle through DTC, where the correspondence on the mutual fund share class is going to the NSCC. So it's making that connection and understanding what that be. And, we're not even sure what kind of volumes we're going to be seeing on the exchanges. What situations will that be? A lot of that will come down to investor education. Do investors even know how to do this? Know it's available to them? But that's sort of one of the key components, I think, of that process. And then there's other operational considerations. But from a core processing standpoint, you're looking at potentially getting data from two different sources. But again, it's just incorporating that data. We currently, we have experience dealing with both sides of that. It's just bringing that in together into the mutual fund now that it's going to have an ETF share classes. So it's really just incorporating that workflow into the current mutual fund process, which I don't think, again, I don't think it's a huge lift. It's just understanding where that data is coming from and knowing that you're going to be incorporating data from maybe a different service provider, and then bringing that all in together into the fund level.
Yeah, I think the other thing to bring up is your service provider that you're currently working with now, do they service ETFs? Does your custodian that you're working with now service ETFs? So those are some of the questions you think about in your checklist you're going through. Avi, the other thing to think about when we're talking about ETF trading on the secondary market, obviously with the mutual fund share class buying directly with the fund at NAV, when you think about board oversight of the bid-ask spreads on the ETF share class, any considerations that you can think of there that you need to be thinking about?
Yeah, it's a it's going to be quite interesting to see how the conversation with the board evolves. There's a lot of signaling here by the SEC and by the way, sort of, this is the direction, this is how you should do it. Dimensional created a template. Now the template is modified, and my assumption, once there is an approval, they say, okay, that is the process through which directors are involved. And I think there is an enhanced level of oversight by directors that does not exist now. And I'm quite intrigued to see how that develops. I think there'll be new reporting, and clearly there are very specific, somewhat principled and somewhat prescriptive about what are the responsibility and what are the reports that the investment manager should provide the directors. One of the area that I'm, as an analyst, I'm quite intrigued is, the cost of a mutual fund vehicle is fairly understood. I don't think the embedded cost of ETFs are sufficiently understood. I'll give you just a quick note. Most of the ETF assets reside in very large ETFs that have very large, volume of trading, and the bid-ask spread is really tiny, and it doesn't change much. But roughly 3/4 of ETFs, in terms of numbers of ETFs, 3/4 of ETFs are not very large. And their bid-ask spread, as reported, is 20 basis points or higher. Now, as reported, and that's the current way it is being reported, there are about 50,000 data points over the last month. And what's reported is a median. It's one number out of 50,000. It's the median of 50,000 data points of the last 30 trading days. By definition, half of those data points are above the median and half are below. But how much above the number are these? If your reported is 20 basis point or 30 basis point or 40 basis point, but half of the data points are above that, are there 41 basis point or 50 basis point or 80 basis point? That's something that currently, I don't think there's a lot of attention to it. There's a lot of analysis. I'd love to see the analysis of that data. And I think there'll be new standards of reporting and new set of questions by director to ask the investment manager, what are you doing with your capital market? What are you doing? This number is comparable to our expense ratio. It is a significant issue for directors. As a director, I have big and I have small, but my responsibility to ask the same question, whether it's a small ETF or gigantic ETF, and if there are expenses embedded in the vehicle that are very significant for the shareholders or the advisors who are trading in and out of that ETF, that there'll be more disclosure and more discussions about this issue. So bid-ask spread is just one of the data points.
I think you're right. I mean, what you're bringing up a good point though is you have a mutual fund, you launch your ETF share class. ETFs are not bought, they're sold. And so just because you launched an ETF share class and you have this great track record from your mutual fund doesn't mean that you're going to get assets in that share class. And then, the market makers might not want a bunch of, like you described, a bunch of ETFs out there that don't really have any trading activity, no flows coming in or out of them. That's not going to be helpful to the ecosystem. There's costs associated with that as the investment advisor, right? That launching an ETF share class, doing all this stuff that we're talking about, infrastructure, board oversight, operational aspects. And if you don't get the assets in there, then it's all for nothing. So I think one of the things we could talk about a little bit is on the distribution side, because I think you got to have distribution, which is one of the most important things. I guess just how you think about the capital, the intermediaries, having your product on there as a mutual fund share class, and then launching an ETF share class. How's that going to work with the intermediaries? Some things to think about there.
There's a lot of wood to chop there. I think it ties back to some of my comments before about the framework of kind of product development and kind of, rounding out your platform. So you have to think about what managed wealth platforms are you on today, and what is their sentiment around this mechanism. And some of the trade-offs could be that because of your incumbent footprint and the channels that you're already pushing into, maybe it makes more sense just to launch something as a standalone versus bolting on and appending a share class. The three big issues, I'd say, that most intermediaries in wealth platforms have identified, publicly at least, are around suitability, so regulation, best interest, and some of those clone challenges if something's already on the platform. The other one, which ties back to what Mike was describing, is just technology and infrastructure and being able to, manage this process at scale. It's being done today on a smaller scale, or at least I should say a more intermittent scale, with regards to ETF conversions. But depending on how transitions tax-free take place, there's a lot of rigor, oversight, and responsibility that's being thrusted on them. And then the last thing touches on just remuneration, and you've got an entire industry that's built up around the 12b1 fee traditionally, amongst other mechanisms. So how do the current state of economics play out over the coming years? What type of conversations are you going to be having with your partners, and how does this particular mechanism fit into that? And then, Brett, to your comment around capital markets, I know the earlier panel mentioned on the exchange panel the ubiquity of products. I think it was mentioned 750 were launched last year. Some multiple in excess of that is going to be launched in 25. Whether this gets approved or not, the reality is there's a scarcity of balance sheet across the industry. There's a limited number of liquidity providers, and there's a proliferation of listed products. So what does that mean? I think the takeaway, at least from my perspective, is you have to be really calculated and thoughtful around your partnerships, where you spread your dollar, where can your dollar go further with regards to service providers and other institutions, trading counterparties. And then I think, the analogy I've been using with clients to kind of illustrate this is, if you think about the financial crisis and some of the regulations that went into place there, the Basel Accords, I think 2015, 16, 17, all of a sudden there was the realization that committed credit wasn't free anymore, and it had to be in the construct of other partnerships with an institution. All of a sudden, a redemption line was challenging to get with the banks. And this is my personal thesis, I think there's a bottleneck coming, that could liberalize depending on how things shake out. But I think it's very important for issuers and other stakeholders to think about that. How are we going to digest all this product over the coming years?
Yeah, it goes back to the point of like putting together a plan. You got to have a distribution plan, and then talking to those partners about it. And then if you're right now trading your traditional through broker dealers at your mutual fund, is that going to change? Are those dollars going to go to the capital markets piece to incentivize them to support your product in the marketplace? I think the other thing to kind of, we're talking a lot about ETF share class of a mutual fund, but Josh, I didn't tee you up for this, but there is applications out there for mutual fund share class of ETFs, which I think this audience would be interested in as well. Just where we stand with that and some of the thoughts with respect to that.
Yeah, that's right. It really doesn't get talked about a lot in this context, but the application would equally allow for an ETF to launch a share class of a mutual fund. And you might think, why would you want to do that? Well, there are still some channels for which a mutual fund is preferable, in particular the retirement channel. So if you have a popular ETF strategy that you want to try to get access to for the 401k plan, that's going to be a potential avenue, and it may come with fewer of these potential hiccups than what we're talking about in the context of launching a mutual fund to an ETF share class. In particular, you don't have that issue about the exchange privilege, because the exchange privilege as currently contemplated would only be going from a mutual fund to an ETF.
Do you see then, if you run a traditional ETF now that wants to launch a mutual fund share class, do you see charging a 12b1 associated with that? Where do you see that sitting?
Yeah, I mean, it's certainly, starting to be part of the conversation of, how the expense structure is going to be worked out. There's a lot of conversations that need to be had around that. And people, I would suggest, if you haven't already started thinking about that within your shops and outside of your shops, you want to kickstart those conversations.
Anything to add on mutual fund, share class, and ETF for the rest of the panelists? Mike, anything on the operational side? Kind of the same challenges.
No, I mean, I think obviously from a service provider perspective, we're going to leverage the existing technology that supports the ETF now. And, but I'm sure there'll be some tweaks to that process. But, I don't see that as being overly complicated. I mean, it's really just then determining when they do from an ETF share class perspective and looking at how the allocation of expenses happen. There'll be some active conversations on what makes sense because the existing allocations that you have within a mutual fund are going to have to be reviewed to make sure they still make sense. And there might be a lot more class levels specific expenses going on now in that processing. But
And Navi, I think one of the things that we talk about with some of our mutual fund boards that are thinking about this or converting to an ETF is that education on the trustee level. Do you think do you have to add to your board that you currently have? Do you think where do you get that education for the board members when you're thinking about a totally kind of different product than you've been managing for the last 30 years?
Yeah, I think the ICI and the directors, the director organization have been spending a lot of effort to introduce this conversation. I was recently in Washington at the ICI conference, and I think the event that was sold out and standing room only was the one dealing with this particular issue. I think clearly there is a need for additional education, for additional guidance. I think the lawyers in that space will prescribe and keep the directors sort of as they always do in the right lane for what we as a director need to what we need to know. But that's clearly one of the important area of focus because until the directors are comfortable with whatever you're trying to do, I mean, clearly there's a lot of things you do in parallel, but until the directors like it and accept it, and directors don't meet, every day. So the idea is to, as part of the plan, to have a very clear, direction for how you would deal with the directors of this emerging vehicle.
Avi, do you believe that this is kind of the final capitulation point with regards to the blurring of lines across, trustees that got away with, ETFs aren't my thing, that's for this one individual, or a lot of times these reside in different trusts now, and now you're thinking about appending share classes to a predominantly mutual fund trust. Like, is this where it all kind of the alchemy comes together?
I mean, I don't like the word capitulation, but clearly, if you have a strategic viewpoint, if you are a George Gatch, if you have a strategic viewpoint and you ask yourself 5-10 years out, this is as I alluded before, I think this is an important element in how the entire ecosystem is moving going forward.
Josh, I know there's been I think it's important to bring up, there's been a couple of exemptive reliefs filed out there that are on behalf of a series trust and not necessarily the advisor or the issuer. We see in the marketplace, there's a lot of these platforms that have lots of different advisors on their platform. And do you have to get exemptive relief at each advisor level, or can you file at the platform level?
That's how it has traditionally worked, is that it's been the advisor that's gotten the exemptive relief. I have noticed a couple of these series trusts and been asked this before. to the extent that those series trust sponsors are having conversations with the SEC about ways to streamline the relief, I've not been a party to those conversations, and I don't know where they're going to go. So I would say the bottom line is that's not how it's historically worked. But we are in a new era right now of regulation, and it is clear to me that the SEC staff has been directed to move forward with this in a relatively efficient manner. So it is possible that we do see that at the series trust level.
Do we have a rule that's then issued? Because then, you think about, I know series trusts that have, 20 different advisors in them, lots of different fund families. It would seem like a lot of work to have each individual file that application for exemptive relief.
Yeah, I mean, well, there are a lot of exemptive applications out there now for the various. So the staff has a lot of work ahead of it. The way that we've seen evolutions in the ETF regulatory space over time has been iterations of the exemptive relief. So as I mentioned, this particular exemptive relief would require daily portfolio holdings disclosure. So you could imagine people wanting to try to expand that to semi-transparent and to allow for other strategies. You could imagine that over time, as the staff gets comfortable with the operation of ETFs as a share class, that they do embark on a rulemaking process, but that could be several years down the road.
I want to make sure we open it up to questions for the audience if there's anything that you want to hear from the panelists on. Oh.
Thank you very much. A question related to looking at, let's say, in a future state where we have ETF share classes with mutual funds. Currently, mutual funds have the ability to close for new creations, whereas in recent years, the ETF the SEC has made it more difficult to close ETF creations. So, in a future state, what are the potential implications when a fund, especially an actively managed fund, becomes larger? Questions such as can you keep an ETF share class open while closing mutual fund creations? Does the inability to close an ETF for new creations mean that extends over to the mutual fund share class as well? Just want to see if people can share some color around some of those future state decisions.
Josh, you want to?
Sure.
Stay
Hey, Steve, good to see you. So there are going to be limitations on the use of the product. I've heard it mentioned at least a couple of times this morning that not necessarily every strategy is fit for purpose in an ETF. And so where we are right now is you're going to have to do a significant amount of diligence at the outset and think about these issues down the road and not launch a product that is going to run into this issue. I do think that eventually the conversation is going to have to turn to what solutions might exist to the extent that you've got to close a share class. But we're in sort of early days of thinking about that. And right now, the idea is to not get into that situation.
Let me just add a thought. I don't know how many traditional high-performing small cap mutual funds are getting so much new money in that they have to consider closing. So it seems to me it's one of those questions that maybe it was relevant at some point had we asked it 10 years ago, 20 years ago, but the likelihood of this very rare situation materializing at the future, point in time is fairly tiny, if at all.
Yeah. I think the other thing to bring up, Steve, is can you short the ETF share class knowing it has a mutual fund as well? So that would be part of that same discussion.
What also ties into that concept a little bit is the notion that when we talk about disclosures and reporting and kind of the empirical evidence of efficacy on day one, that can change over time. And the proportion of share class that's ETF versus non, it might be very small. Some things might be, I think you have to calibrate over time as conditions change. It might sound obvious, but it's not a static state when it comes to evaluating some of these concepts.
Yeah, that's a good point. Other questions from the audience?
Thank you for this. Paul, you had mentioned a bottleneck in the future. Say you're a smaller firm that maybe doesn't have huge trading relationships and all of the balance sheet is taken up. Do you think there's going to be a solution to that? Do you think there's going to be options for smaller firms that maybe aren't Vanguard or Capital Group in the future?
Yeah, and in my comments about leaning into where your dollar goes the furthest doesn't necessarily mean it's around trading. It could be around things like administration, custodial relationships, banking relationships. I think that the totality of the all the connectivity you might have with an organization will go into that arithmetic, and I think it's going to rhyme with how banks have started to, or at least traditionally the last 5-6 years, think about committed credit, which has a capital cost, which has there's a scarcity of balance sheet, and regardless of what you quote unquote are paying them, you have to deploy it as effectively and optimally as possible. I think this is just a different flavor of that, and it's having a very constructive and pragmatic approach around where you're doing business. I think will be very important.
Got a question way on the other side.
I was wondering if I can get your thoughts about the custom basket process, right? So ETF portfolio managers love their custom baskets. It helps to create the tax efficiency behind ETFs, of course. But a couple of comments today have been about the limited number of service providers. We're getting an influx of new ETF shares that all the mutual fund shares are ultimately going to use the ETF share class for those custom basket transactions. You know, back in the day, custom baskets had, you know, zero stagger, right? You do the custom and the redemption on the same day. Now there's typically 1 or 2 days, so capital's being used up. What do you see as the impact of the ETF share classes on the very act of custom baskets and tax efficiency on the ETF share class overall?
I mean, I'll take at least the tax perspective. You know, say you don't do a custom basket and you have your mutual fund share class and you're trading just as you always have, shareholders coming, you know, redeeming out of the fund, and you have to sell securities and you generate capital gains. The answer to that is you have to pay the capital gain tax out of the fund, and that's at the fund level, not at the class level. So both classes would be associated with that capital gain distribution. So that's the tax piece of it. I'd let the panelists speak to the capital markets piece of, is there balance sheet to do those transactions in the marketplace?
Yeah, I mean, I think you're going to find, obviously, we sort of talked about capacity, talking about this on previous panel discussions as it relates to market makers' ability to participate. So it's going to come to developing that relationship with the market makers, however that should be, whether it's making sure that you're actively trading with them, or there's some sort of, you know, global relationship that is bringing there. Because at the end of the day, you know, market making in some cases, these folks is a loss leader, and they're looking at other areas of the business with you to sort of make that work. But there clearly can and there will be potentially capacity constraints around custom baskets. There are now with the players here, depending upon the time when you want to actually do your custom. So it's very much you're working very closely with your partners into making sure that you can effectively manage that process. But I think it will, you know, unless more market makers come into the space, there's going to be some capacity constraints there.
I don't think it's just SIBs either. I think, you know, external seed with regards to getting things off the ground is going to be in the same, you know, association.
Well, I want to thank my panelists. Please join me in thanking them. And if you have other questions, we'll be around.